So I've been an investor in ARK Invest for a little over 6 months now, and even prior to that, you could kind of see the interest build over time in the company. Well, 2020 has ended in a fantastic year for them because now ARKK, which is their flagship fund, is officially the largest actively managed ETF by assets under management. Now, as an investor of ARKK and somebody who believes in them, this is fantastic news as well. But one thing that always gives me a bit of worry is that when there's too much hype. So if you've heard about ARK Invest, Cathie Wood, and are a little bit curious and you want to know more, this video is made for you. I'll give you an overview of them and their products, the 3 reasons of why I chose them, and finally some considerations to balance out the hype should you really be interested in investing in them as well. What's up guys, it's Sun Min here and welcome back to Your Money Game, the show where we get better with saving, spending and investing. ARK Invest is a relatively new fund management firm which was launched sometime back in 2014. But it was formed by Cathie Wood, who already had a multi-decade career in investing, and ARK Invest was formed around her core principles and beliefs in investing in disruptive innovations, specifically 5 platforms. And these are artificial intelligence, robotics, DNA sequencing, blockchain, as well as energy storage. So the hope is all these innovative companies will disrupt really legacy industries and hopefully unlock a lot of growth and therefore produce returns for you as investors as well. But for the purposes of this video, I'll only be focusing on their actively managed ETFs. And again, thanks to the fact that they're easy access because we can just buy them off any shelf if you have access to the US markets. So here's a quick summary of those ETFs. It begins with their flagship ARK Innovation ETF, ARKK. Think of this as the master fund, which cherry picks the best of the best companies across those 5 platforms and bundles it into one ETF. Naturally, underneath that master ETF, you have individual ETFs that target those specific themes I mentioned earlier. There's ARKQ for autonomous technology and robotics, ARKW for the next gen internet, ARKG for genomics, and ARKF for fintech innovation. And all these ETFs have an expense ratio or management fee of roughly 0.75%. And here are the 3 reasons that kind of persuaded me. The first is Cathie Wood herself. And even though ARK Invest is relatively new, what was reassuring is looking back into the history of Cathie Wood, she has always been an innovator and a bit of a disruptor. As a young analyst, she was already looking for disruptive new companies that some of her older colleagues were just really ignoring. Fast forward to today, and I really appreciate her fearlessness in willing to go against the grain and be publicly against some of the very established voices in the industry. She was one of the earliest believers in Tesla, as well as Bitcoin when she was an investor back when the price was around $250. If you end up becoming an investor, I would really encourage you to just watch a couple of her videos on YouTube, and it's easy there to see her passion and conviction as she speaks about the topic. Next is that her contrarian beliefs and entire approach is actually nearly opposite of what I've been learning and trying to practice in my own investing. But yet it made sense to me. My style as an investor is more index investing oriented, where I use ETFs to buy large segments of the market. So one of her core beliefs is that indexing as an approach is quite flawed, simply because indexes tend to include such a large number of stocks that they are bound to include slow performers or really laggards in the industries. And it's those laggards that the companies that she invests in are hoping to disrupt. I wanted exposure to some of those innovative companies that she speaks about, but again, I don't want to go into cherry picking stocks, so I'll rather buy an ETF like ARKK. The third reason is the firm's focus and the way they approach things. Like I mentioned, they're so focused in pursuing disruptive innovation, and they're not beholden to specific indexes, geographies and sectors, and that's what I appreciate, which is that level of freedom but focused in getting the kind of results which they look for. And you see this in the way she builds her teams as well, where they previously might have been picking the best of the best MBA students from Ivy League schools. Instead, she chooses to also include quite a lot of specialists within the tech and industries that she is investing in as well. But with all the talk of innovation, I hope that it's not too disruptive for you to click on that like button and maybe even subscribe, because all that really tells YouTube is that this video is worth sharing to more people. So those are my 3 reasons of why I chose them, and chances are if you're watching this, you're also kind of interested in them, and for good reason. They've had an amazing year. ARKK itself ended up the year 148%. ARKG was even more impressive by ending the year up 185%. So, who doesn't want a piece of that pie? But before you rush it and throw money in the face, here are some of the things that you really should consider as well. The first is an often ignored disclaimer which you see pretty much everywhere. Past performance does not indicate future performance. And there's a good reason why it's everywhere. There's been plenty of research that shows that top performing funds in one period tend to lag in their performance in the subsequent years as well, which simply goes to show that it's very difficult to sustain such great performance over a long period. But you might be saying that, hey, isn't Cathie Wood that amazing superstar that managed to grow ARKK as a flagship fund an annualized 30+% since its inception in 2014? Yes, like I mentioned earlier, that's exactly one of the reasons why I decided to choose them. But in spite of all the admiration that I have for her, I'm reminded that in the Wall Street universe, there were legends such as Julian Robertson and Bill Gross, who were once like these giants and almost godlike figures, who now today become lessons that it's actually very difficult to hold on to strong performance over a long period. Basically, even rock stars can lose their edge over time. The second consideration is that usually after such a successful run, prices either tend to fall to correct themselves or they stagnate and go nowhere. In a recent interview with Bloomberg in the middle of December, Cathie Wood herself was kind enough to admit and warn investors that, hey, a correction might be coming.
And whenever things have gone this well for me, usually there's a correction around the bend, and I want to gird for it and protect it, and also prepare our investors for the possibility and say, just keep some powder dry.
I've attached the full link to the interview below if you wanted to watch it. The third real consideration is your risk tolerance for volatility. Sure, right now we're celebrating that ARKK had an amazing 2020. But let's just take a look back 2 years ago in 2019. They had a fantastic year as well with a 34% gain. But within that same 1 year period, there were 2 incidents where you would have to experience a 20% drop in total value. But it gets worse in 2018. For the year, ARKK ended up roughly 0.3%, which is not that great. But from the peak to trough, the total drop was roughly 39%. That kind of decline is really eye-watering. And no matter who you are as an investor, you've got to have nerves of steel to really be able to hang on to the kind of conviction that it needs for a fund this volatile. You've got to ask yourself, can you really handle the heat? Because if you're allocating a large proportion of your portfolio to them, be prepared for one hell of a ride. Finally, if you are going to buy them, just be mindful about how concentrated they are. There's roughly 48 stocks in ARKK itself right now, but it's similar in terms of like 30 to 15 level of stocks when it comes to the other funds. But even within each fund, they tend to allocate quite a large percentage to the top stocks within it. For example, in ARKK, the top 5 stocks account for 33% of the value of the entire portfolio. Tesla alone is 11%. Speaking of which, if you happen to be interested in investing in multiple funds, I would just caution you that Tesla happens to be in a few of them. So they are the largest holding in ARKK, ARKQ, and ARKW. So by buying multiple funds, you might end up having too much exposure to one name. So just make sure you do your due diligence and research what is the underlying stocks that you're buying within each ETF. So at the end of the day, it's your decision, but I just want to personally caution you against allocating too much of your portfolio towards any of these ARK Invest funds. In the interest of full transparency, I have roughly about 9% of my portfolio allocated towards them, and they've done well for me so far. But at the same time, I am very wary about the level of volatility to expect. So what are your thoughts about them? If you decide to become an investor, hey, share it with me below in the comments and let me know what you decided to do. With that said, I hope you guys found this useful, and if you did, I would really appreciate your ongoing support in clicking that like, subscribe, as well as that bell button, and I'm going to be back again next Sunday with a brand new video, and until then, you take care and keep playing your own game.